What's up, everyone? Welcome back to Thoughtful Investing. With the Fed signaling a rate cut in September, the real estate sector is back in focus. While everyone talks about home builders and building material companies, we're going to talk about the best tech stock in real estate, which is CoStar. It is a powerhouse that dominates commercial real estate and is now making a big push into residential. If you care about growth, this company has had 57 consecutive quarters of double-digit growth, including COVID. We're going to dig deep into the company and find out how this company makes money and really differentiates itself in the marketplace. I'll talk about the huge growth potential for its various business segments. Then we'll look at the financials where I'll focus on growth, profitability, and solvency. And finally, I'll perform a detailed valuation of the stock to help you understand what's embedded in the current price and at what price it could be a potential no-brainer. So let's get started. CoStar was founded in 1986 by Andy Florence in a college dorm room. The stock IPO'd in 1998 and has been growing steadily since then. Basically, the business has two parts: the legacy information side, which is represented by CoStar, and the platforms, which include LoopNet, Apartments.com, and Homes.com, along many others, which the company have acquired over the years. We'll look at all of them in a minute. Back in 2008, CoStar's revenue was almost entirely information services, 92% from the core CoStar platform. Fast forward to today, and the business is far more diversified. Information and analytics still make up 42%, but marketplaces drive 58% of the revenue. It's a nice setup because CoStar has now got diversified revenue streams that work in all types of market conditions. Let's start with the information and analytics side of the business. Imagine you had $100 million and you wanted to buy an apartment building. With CoStar, you can search every multifamily property on the market or even off market. You can filter by units or by year built or any other attribute. Once you know which building you want, you can get rent comps, sales comps, historical pricing trends, and actual income and expense data for that property so you can calculate your return on investment. Let's say you want to know more about the neighborhood where the property is located. Is it an up-and-coming neighborhood or is it going downhill? CoStar can show you demographic info, the population trends, the income profile, the rental demand, whether it's going up or down. Now, let's say you're curious about who owns that building across the street. Well, CoStar has ownership data, contact info, and transaction history for that building too. Now, that's just one example. The same logic would apply if you wanted to buy an office space or a hotel or a shopping mall. So if you're buying commercial real estate without using CoStar, you're basically flying blind because no one else has that kind of data. CoStar has literally spent decades and billions of dollars collecting this data using every conceivable method, from in-market canvassers to drones to an army of analysts, researchers, and software developers. And they're very protective about their intellectual property. CoStar has a rich history of suing anyone who has used their proprietary data without permission. Some of their competitors have even gone bankrupt due to these legal battles. Now, you can only spend this kind of money on data collection and legal battles if you have enough scale to be able to then sell this data to a variety of customers. So who are these customers? This includes brokers who are facilitating these transactions, investors like institutional investors or real estate investment trusts who are looking to buy and sell property, the lenders and financial institutions that are financing these deals, developers who are planning new projects, even corporations who are looking for new office space or industrial space. Basically, everyone who's involved in commercial real estate is a customer. Now let's move on to the marketplace side of the business. CoStar acquired Apartments.com back in 2014, and since then it has gone from 5th place to number 1 in the industry. Revenue is up 13 times, traffic is up 11x, and customers have quadrupled. For me, this really demonstrates CoStar's strength in buying underperforming assets and scaling them to be market leaders, and really gives me confidence about their future acquisitions. LoopNet is another big platform they've acquired and scaled. It's like the Realtor.com for commercial real estate. It helps users buy, sell, or lease commercial properties like office buildings, hotels, retail spaces, etc. And just like Apartments.com, LoopNet's revenue is up 6x since acquisition, and it's still early. With a $5 billion addressable market in North America and $15 billion globally, this platform is scaling very nicely. So far, they've expanded in Canada, the UK, Spain, and France. Bit by bit, you can see CoStar laying the groundwork to become the global leader in commercial real estate. On the Market is another platform they acquired in the UK, and it is taking off as well. Traffic, visitors, listings, everything is up and to the right, and it's giving it tough competition to Rightmove, which is the current market leader. By the way, if you're enjoying the content, please subscribe to the channel so you don't miss out on future videos. Now let's talk about Homes.com, which is CoStar's entry into residential real estate and their biggest bet. They are competing here with Zillow, which is a household name, but there's a big difference between Homes.com and Zillow. On Homes.com, when you click a listing, boom, the listing agent's info is right there. Now compare that to Zillow. When you click Request a Tour, you're not reaching the listing agent. You're actually contacting Zillow, who is selling your lead to different buyers' agents. So why does this matter for both buyers and sellers? Let's say you want to buy a house. It's simple. You get the most attractive straight from the source info. You're not stuck playing telephone with the middleman. You're talking directly to the person who knows the property best. That means faster answers, fewer mix-ups, and a smoother buying experience. Now, let's say you're selling your house. It's huge. When your listing is online, you want those hot leads coming directly to you or your agent, not getting rerouted somewhere else. Homes.com makes sure your listing agent stays front and center, and you don't lose potential buyers along the way. This direct connection helps both sides get deals done faster and with less friction. So ultimately, it is a superior business model for everyone involved. Because of this superior value proposition, Homes.com is now the number 2 residential real estate marketplace, reaching 110 million monthly visitors, nearly double Realtor.com, and closing in on Zillow's lead. I'm personally excited to see how this plays out in the next few years. Let me know in the comments section if you have used both Homes.com and Zillow to search for a property and which one you like better. Let's talk about growth opportunities. I think it's going to come from both organic growth and acquisitions. In the current portfolio, each segment taps into a huge market, and in most cases, CoStar is the market leader and growing fast. The CoStar suite has a $4 billion addressable market, Apartments.com at $9 billion, LoopNet at $5 billion, 10X, which is a platform for selling distressed commercial real estate at $6 billion, and the biggest opportunity, Homes.com at more than $15 billion. So every one of these businesses still has significant room to scale. As you know by now, CoStar has a long history of successful acquisitions. Apartments.com, LoopNet, Homes.com, and now on the market. Each one of their acquisitions has been fully integrated and scaled, fueling consistent growth. In 2024, 24% of revenue came from acquisitions, but the real story is how CoStar turns every deal into a long-term organic growth. In late 2024, CoStar acquired Visual Lease for $276 million, which you see at the top right of the chart. And this added lease management and accounting tools, which I think is going to be another growth driver. Then, early this year, they completed a $1.6 billion deal for Matterport, a leader in 3D visualization technology that will drive even more engagement on each one of CoStar's existing platforms. We're going to dig into the financials now. For companies like this, I'm looking at 4 things. Firstly, growth. I'm looking for consistent growth across different business environments to prove that the business model really works. Secondly, profitability. If you're unprofitable, then the more you grow, the more money you lose. It's okay if the business is currently subscale and unprofitable, but I want to see a clear path towards profitability in the future. Thirdly, shareholder friendliness. If a business is doing well, I want to participate in it as a minority shareholder. But if management keeps issuing high levels of stock or compensation to themselves, I'm never going to see much upside. So I like to keep an eye on dilution. And finally, solvency. I want to make sure that the business is conservatively financed and not carrying excessive debt. Because if they go bankrupt, nothing else matters. I'm going to lose all my money. Starting off with growth, this slide is from the end of 2014. But by now, CoStar has delivered 57 straight quarters of double-digit revenue growth. And one thing I like about this company is how resilient their revenue is. Imagine yourself as a CoStar investor back in 2009. All type of real estate is crashing. The market is in free fall, and no one knows what's going to happen next. You look at CoStar's revenue and expect to see it dropping like a rock. And what's the actual change? Well, just 1% reduction. Similarly, during the pandemic, while transaction volumes represented by the yellow line are down significantly, the revenue just keeps going up. This is why I'm a big believer in quality companies, because they offer protection on the downside while still delivering upside over time. We have already discussed the revenue. The operating income and net income is a little bit more mixed, and that's because companies that acquire a lot of other companies have non-cash charges on their income statement that depress the operating income and net income, but they don't impact the operating cash flow metric as much, which is why you're seeing that the operating cash flow has kept going up until the last couple of years when they started to aggressively invest to scale Homes.com. Moving on to profitability, you can see that the operating margin, the net margin, and the free cash flow margin kept rising until 2019, and that reflects growth in the existing businesses. But then it took a bit of a dip during COVID and rose again in 2021 and 2022. But more recently, this has come down as well, and this is a reflection of the aggressive Homes.com investment. The core business, I believe, is just as profitable as it was back in 2019. It's just that the new ventures are sucking up all the cash, and eventually when they become cash flow positive, you will see these margins revert to the high levels that we saw in prior years. The same is true for ROIC, which is return on invested capital, and ROE, which is return on equity, and these basically measure the underlying profitability on the capital invested in the business, and in case of ROE, the equity invested by the shareholders. Both of these metrics peaked at the same time as the margins back in 2019, and since then have trended down, reflecting the same issue that we saw in the previous metrics, which is the aggressive investment ongoing in Homes.com and other ventures. And I expect these metrics to revert to earlier levels just like the margins as those investments mature and start producing cash flow. In terms of shareholder friendliness, you can see that the share count has continued to go up. Part of the reason is because at some points in time, CoStar has issued equity to raise the capital to make acquisitions. But we saw that when they did make those investments, they were able to scale them to the next level. So that was a great use of capital. But of course, that's going to lead to a little bit of stock dilution. The long-term average is 3% year-on-year dilution, and that's partially offset by the stock that they have repurchased at opportune times, especially in the last 12 months where they've bought back more than $100 million worth of stock. If you look at their stock-based compensation as a percentage of revenue, it's hovering around 3.7%. That's the long-term average, and that compares very favorably with companies like Microsoft, which is at 3.6%, and much lower than companies like Meta, which are trending close to 10%. And then finally, let's talk about solvency. If you look at their net debt, it's basically negative. Net debt to EBITDA also negative. What that tells you is that there is no debt, which means that the risk of bankruptcy is minimal. In fact, they have surplus cash sitting on their balance sheet. If you look at current ratio, which is the ratio of current assets divided by current liabilities, their current assets can cover their current liabilities 6 times over. And speaking about that cash on the balance sheet, it's been building up for the past few years. Right now, they're sitting at $3.7 billion of cash. And this is great because it means that they don't have to issue any more debt or stock to continue the investments in Homes.com and other ventures. And also, if there is a big correction in the market or a big crisis in the economy, they will have the firepower to make even more acquisitions, paying penny on the dollars. If you look at all 4 of our criteria, growth, profitability, shareholder friendliness, and solvency, it's clear that CoStar is doing reasonably well in all 4 of those categories. Now let's move on to valuation. I'm going to do a base case, a bear case, and a bull case. For the base case, I'm assuming that Homes.com maintains its number 2 position. The other CoStar platforms like Apartments.com and LoopNet remain steady, and margins normalize but at a level that's lower than the peak margins of 2019. In that scenario, I'm assuming an 11% year-on-year growth, which is slightly lower than the 12% that they have delivered over the past 3 years. I'm also assuming that there will be no free cash flow for the next couple of years as all of the cash flow will be sucked up by Homes.com. And then as we saw in the chart on shares outstanding, I'm assuming a 3% dilution, which is consistent with their long-term average. I'm also assuming that the price to sales multiple remains at the current level of 13. In that case, the fair value in 2029, according to my model, will be 131, which will deliver a 7% year-on-year return. That's pretty much a market equivalent return and not something to get terribly excited about. But the thing about these quality companies is that they can often surprise to the upside. Next, we move on to the bear case. In that case, I'm assuming that the Homes.com investment completely stalls. There are macro headwinds that impact their other business segments, and there's also a multiple compression from the current 13 to about 10. In that scenario, I'm projecting the revenue growth to be about 8%, which is about half of what they have delivered over the past 10 years. I'm again assuming that the free cash flow for this year and next year goes to Homes.com, and then the margins recover slowly, but at a level that's half of where they were in 2021, which is about 10%. I'm still assuming a 3% dilution for shareholders. And in that case, the fair value in 2029, according to my model, is 87. So basically flat with where the price is today. And in that case, there's not going to be much return, but the downside is also limited. And finally, the bull case. In that case, I'm assuming that Homes.com beats Zillow and becomes a market leader. CoStar's data monopoly further compounds. Margins expand back to where they were around 2019, which is 28%, and the market awards a higher multiple to CoStar in recognition of its success. In that case, I'm projecting that the revenue will grow at 15%, which is still a touch lower than their 10-year growth of about 17%. All the free cash flow for this year still goes to Zillow, but then it starts recovering and eventually the FCF margin goes back to about 28%. I'm still assuming a 3% dilution, and in that case, the fair value in 2029 is about $182. In that case, the year-on-year return is going to be 15%. So in other words, if my model is correct, then an investor will basically double their money in 5 years. Here's a chart that shows the 2029 future value compared to the current price. And as you can see in both the base case and the bull case, that future value is above the present price. And even in the bear case, it's not too much lower. Depending on which case you believe in, this chart shows your projected return based on your buy price. For example, if you buy the stock at $82 and believe in the base case, then my model projects a return of about 10%. But if you believe in a bull case, then the model projects a return of about 17%. None of this is investment advice, but just a projection of my model. Personally, I'm potentially interested in the stock in the early 70s. At that price point, my return is expected to be about 12%. My downside is capped at about 4%. And if the bull scenario materializes, I can make as much as 20% year-on-year return, which is pretty good. All right, folks, this brings me to the end. If you enjoyed the video, please hit like and subscribe to the channel. It takes many hours of research for each video, so I would really appreciate if you help me grow the channel. And if you agree or disagree with anything I said, please let me know in the comment section. See you next time.